Hey, welcome back. I looked into Petrobras a while ago as part of a deep dive into oil companies and they seemed very interesting even before. Now, however, they published an important update, so let's look into them. Really quick, if you don't know them, this is the largest public company in Brazil and they produce almost the same as Exxon, so they would be around the fourth largest oil producer on the planet. As you can imagine, the Brazilian government is the controlling shareholder, but that's not necessarily a bad thing, as you are about to see. They present an interesting energy mix now and by 2050. They might be among the only oil companies that confess this idea that oil will be replaced. They expect peak production capacity by 2029 and then production and discoveries would naturally decrease. Also a note here, it might go longer than that since Trump is very likely going to push permits and stuff and I'm not sure they accounted for him. He won again 3 weeks before the presentation came out, so he didn't have an impact on the projects in development or soon to be in development yet. Anyway, if you look at oil companies, they are developing, but instead of opening some huge projects for which they need approvals, they prefer buying the competition. We've seen pretty much all major American oil and gas companies do some kind of merger and acquisition in the past not even half a decade, and that doesn't add anything to the supply. And if anything, the European oil and gas companies are developing renewables more than oil itself. Exxon, by the way, also just announced that they plan to invest a lot into some greener things. They say the oil demand in Brazil should be kind of stable as the country is still developing, but the overall demand on the planet would significantly decrease. This is why, to maintain the company's relevancy in Brazil's growing demand, they are projecting some renewables in the company's mix. We see higher investments into renewables, fertilizers and more that Brazil is kind of forcing them to do, and we can see the focus on biofuels and ethanol. Brazil is a key country in ethanol thanks to sugarcane being probably the most cost-efficient way to produce it, and Brazil is the leader in sugarcane as well. So it's obvious why they are pushing ethanol so much, and I don't think it's something bad. Also, there is some pretty much very new law favoring local investments, royalty reductions and more in the oil and gas industry. It's interesting how the state is encouraging and even forcing companies to develop locally, not only in oil and gas. We saw Valley do similar things with hydropower and railroads, and this stuff could ultimately improve the country's economy. A general risk or opportunity with emerging markets companies is the foreign exchange rate. But a stronger economy, maybe growing commodity prices, combined with somehow a weakening dollar, maybe if money seeks better yields after rate cuts, could be huge for all emerging market stocks. In their assumptions, they see oil at 68 per barrel by 2029, and they also present very useful cash flow sensitivities. $10 per barrel can wipe out or add around 5 billion in operating cash flow. They can make a ton of money, around 30 billion in the current environment. For an 80 billion market cap, this is among the lowest ratios we can find on the planet right now, and this isn't some unknown tiny company, it's the number one in Brazil. Exxon, for a reference, a $475 billion company, makes only a bit more on average. But historically speaking, this isn't that cheap for them. They see capex of 80 to 85 billion during this half a decade, so significantly more than they do now, and together with maybe lower oil prices, the cash flow will drop, but still a lot of money. Based on this, the dividend should be something like 9 to 11 billion per year, meaning around 11 to 13.5% per year, plus maybe another 1-2 billion. So very likely a cut from the current level. It's very close to the lower assumption today, and keep in mind that Trump could push it even lower or it can get even higher, it's a commodity. On the other hand, we'll probably see more production and maybe a bit more demand, plus a potentially stronger dollar, which is generally bad for the price. It would probably be very good for the American economy, but won't be that great for the oil and gas stocks. Still, they say they are breaking even in a scenario with oil at 28 per barrel, so anything above 35-40, which is not sustainable for a majority of US producers, should be okay. Again, another advantage of Brazil and South America in general. The minimum dividend in Brazil is 25% of the adjusted net income, by the way, so they are paying a bit more than that. Financially, we see a bit of an issue in the current assets and liabilities, but the overall debt is not really an issue on so many assets. If they want to, this debt is gone in a couple of years, but they don't have to. They lower the debt over time, but they are going to increase the target since they are investing much more now than before. You get about 72 billion in equity on an 80 billion market cap, so it's definitely starting to get interesting. Comparing them to Exxon, the latter has a lot more equity, but you also have to pay pretty much 2x its value, and again, they make similar amounts of money. The efficiency and the margin of these assets is really remarkable. So a higher return on investment together with much more investments now really has a lot of potential. They are also investing in lots of downstream projects, which can be even better for the company's margin. The margin, by the way, I didn't say, but it's insanely high, something like 25-30% or even more. Exxon, Chevron, Shell are at like half or even a third of that, so definitely not something to ignore. On the other hand, we have Trump potentially boosting the American oil and gas production, which can have a negative effect on the price. Sure, the company itself would probably be, let's say, more okay than others and still make money, but the stock would be affected. As a parenthesis, this would be amazing for Exxon, for example, who directly and indirectly probably contributed billions to his campaigns. That's because they have an incredible amount of treasury stock on the balance sheet that's ready to buy the competition at lower prices. But of course, it's just a bunch of coincidences and allegations, and we can't prove anything. Now let's see a valuation. It's really tough to do, but I'll use very low ratios since that's the reality of this company for now. Say oil drops to 50, so that's minus 12.5 billion from the operating cash flow plus 18 billion in capex, leading to a free cash flow of around 10 billion. That's just enough to pay the dividend, and for a ratio of 2, that's a 20 billion market cap. That's a price of 3.38, so a 75% drop from the current level. We've actually seen something very similar during the previous down cycle and even in 2020. But that was oil at like 35-40, so it can fall even more or the ratio can be worse. Still, from a business point of view, that's enough money for higher capex, so investing plus covering the dividend, so not really such a big issue. I'd say maybe below 50 per barrel is when we can see the issues slightly begin. In a second scenario, with oil at 75, that should be around 25 billion per year. Say the ratio is at 2.5 and we get to a market cap of 62.5 billion, meaning a price of 10.55, so roughly 20% loss. As a parenthesis, I went for 2.5 because it's adjusted for the higher capex, since the company's capacity to make money is the same or even better thanks to the investments. Now, in the long term, with higher cash flow thanks to normal capex and investments, this can probably make like 40 billion per year or even more in such an environment. Keep the ratio at 2.5 and that's a 25% profit. Still, even 25 billion is enough for massive dividends and maybe even buybacks, debt repayments and so on. In a better scenario, with oil at 85 on average, they can probably make around 30 billion per year. For a ratio of 3, that's a market cap of 90 billion, so a very small profit. But after the investment cycle, they can probably get to 45 billion in such a scenario, meaning a decent profit plus potential for massive dividends and buybacks. Again, 45 billion buys half of the company or repays all the debt or almost buys a competitor like Warren Buffett's Accidental Petroleum, so it's a ton of money, especially if they invested at the company's massive return. Anyway, if you want to support the channel and see if and when I buy this, check out the Patreon link below. Usually, you have to think about the potential in this scenario if bought during the first. Say I buy this at 5 during the downside, so a market cap of around 29.6 billion. Not only do I potentially get even 30% or more dividends on average, but during the upcycle, that's like a 5x plus the company making more money in a year than what I paid for them. And if you think that's much, keep in mind that if you bought in 2020 or even 2021, you got a 30-40% dividend just a year ago and they paid more during that time. Plus, there is always the potential for another commodity boom or something that would attract more money to Brazil again. So if I buy at 5, this can even be a 10, 20x or even more on top of massive dividends. So even with lower prices, this can still continue to do very well as a business. I looked into them before together with many other oil companies, and it was the same as Valley versus the other iron miners. Both Brazilian, so with higher potential, much cheaper, higher dividends, lower costs, and sometimes even higher commodity quality. Don't forget that during the previous commodity boom, this was in the 70s and it did much better than the American competition, so the market sentiment can make a huge difference. Who knows, maybe after so many inflationary policies and all this money printing everywhere on the planet, we might eventually see that again. Plus, Brazil is definitely a country to keep an eye on even without a commodity boom. Overall, very good company, huge margin, okay financial health, very low break-even and definitely cheap compared to pretty much anything. But is it low for them in particular? Not really. Still, with a new investing cycle and huge potential on top of Brazil itself, this can be a very profitable long-term investment, especially if bought during the downside. But maybe Trump manages to push the oil prices lower and could potentially make this a very solid buy, together with several other oil and gas companies. The potential dividends alone, ignoring the upside, are massive and definitely attractive even today. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out, and make sure to subscribe. Thank you for watching and I'll see you next time.